So if everyone wants to turn off their cameras.
Hello and good afternoon. Welcome to our event Compensation Confidential. Good afternoon. My name is Ruben Pace and I'm Program Manager of LaunchBio. For any newcomers to the program, welcome. We're happy to have you join us. LaunchBio is a national nonprofit dedicated to supporting life science startups on a path to creating novel treatments, tools, and technologies for the benefit of human health and well-being. We create ecosystems of innovation through hosting educational programs and events and fostering meaningful connections throughout our communities. It's been another wonderful year full of so many great events, and it's a pleasure to have seen so many of you there too. So thank you for your continued support. Whilst this year is coming to a close, there is still plenty of events and opportunities to connect through our programs. So for more information, please check out the launchbio.org website for any up and coming events. Before we begin, I would like to take this opportunity to thank our sponsors, whose generous support and commitment to our mission enables us to put these educational programs and events on. Our sponsors are an important part of LaunchBio community. We value their industry expertise and high level of professionalism. Please reach out if there's any area of your business that you need support in. I'm sure we can offer some support and help. Our program today is in collaboration with our presenting sponsor and value partner, Wilson Sonsini Goodrich and Rosati, a beacon of support for the biotech community and a firm that is synonymous with ushering promising and innovative technology and life sciences companies through their business life cycle. We are proud to collaborate with such a respected institution. Today's program is part of our Compensation Confidential National Webinar Series, highlighting the latest insights and analysis into compensation for privately held life science and tech companies. We encourage our viewers to be interactive, and so please submit your questions via the chat, and we will aim to incorporate them during the discussion. I'm honored to introduce our panel of experts today. We have with us J.Thelander, founder and CEO of J.Thelander Consulting, Christine Leon Connors, President and Partner of Epic Capital, and Scott McCall, Partner at Wilson, Sonsini, Goodrich, and Rosati. So without further ado, let me turn the time over to Jody, Christine, and Scott to further introduce themselves and get us underway. Thank you.
Great. Thank you, Ruben, and to LaunchBio. Well, I'll take the lead here. J.Thelander, founder and CEO of J.Thelander Consulting. And we have a great relationship with Scott and Wilson Sonsini. They've been amazing partners with us for more than 20 years. So I echo exactly what LaunchBio said, because Scott in particular is an expert in compensation and benefits and has been a source of many of the content for our questions because he sees real time what's going on with his clients. So Scott, I'll let you add if there's anything else to add right now. I know you are really in the thick of it with private companies and life science companies across the globe. So fill us in on what you're seeing. Oh, Scott, I think you're on mute.
Thank you. More than one button you have to hit nowadays, so sorry about that. My name is Scott McCall. I'm a partner at Wilson Sonsini. I've been doing this for about 25 years. And yeah, I work with a large array of companies, early stage startups to kind of big public companies. And we work quite a bit in the sort of life science space and get to see a lot of different sorts of compensation arrangements for different people in different contexts. So excited to be part of this panel and share our thoughts for today.
Perfect, great. And Christine Leon-Connors, who has been we have been working together also for decades, and Christine's expertise is in the wealth management strategies, all the planning for the ways from the minute you get your first, equity grants and founder shares and funding to a liquidity event to make sure that there's wealth creation, that you've looked at all the strategies to maximize your wealth and minimize the taxes. And Christine and her team have all kinds of expertise in this area. And it's extremely important that the three of us are here together because we have the data on the compensation. Christine and her team have the expertise on what to do with those percentages in your actual terms. And Scott is, of course, crucial to understanding how to put all that together in employment agreements and the other areas where you're dealing with the board. So Christine, so great to have you. Fill us a little bit of what's going on at Epic Capital and what you're seeing in the private markets.
Thanks, Jody, and thanks, Scott, and thanks to Ruben and LaunchBio. I'm super excited to be here again. I think Jody and I have been doing this for so long, she can give my background without me having to add too much more. But what I would say is, as we advise mostly entrepreneurs, but also a lot of venture capitalists and funders on the other side, is really being able to see some of the trends. And one of the biggest is really just, founders who become founder CEOs who move along kind of that path of growing their company don't often stop to really focus on what they have, and understanding what you have is key. Understanding the tax impact of what you own is even more critical, and the planning all along the way and not waiting till the end is often where we see a lot of entrepreneurs, executives kind of making the mistake. Everybody, kind of thinks, well, we'll take care of it. I want to take care of my executives. I want to make sure my entire company team's taken care of. And that is incredible and amazing. But you also have to be mindful of your own planning along the way. So we'll dive into some of those strategies as it relates to planning for yourself, and it will tie in nicely to what Jody is going to cover with the compensation. But, I would say overall, the biggest right now is let's use this opportunity where valuations are slightly depressed, where the opportunity where things are a little bit private for longer, if you will. That's going to change, and it will change, and take this as an opportunity to really review what you own and how you own it, and are there other planning opportunities that you can do along the way. So why don't we dive in, Jody, to some of the data. We'll monitor the Q&A, so you guys throw in whatever you might have along the way in the chat, and we're happy to answer that as it comes up, and we'll all just play off each other like we normally do.
Yeah, I think I'm going to jump in. Everyone can see my slides. So we've got a lot of information here, more than we're going to cover. We'd like to navigate around based on what your questions are. Morgan and my team is monitoring the chat. So if you would like us to pivot or to go into more depth or have one of us answer a question specifically, please go ahead and write in the chat. And Morgan is going to text us behind the scenes, so whomever's not talking is going to look at it, Christine or myself. And so Scott, don't worry about that, and we will make sure that we get answered what you want. So I'm going to jump right in. The nice thing about the J.Thelander data, we've been doing this for over 25 years, surveying private companies on all aspects of compensation. And the best part of what J.Thelander has done in the last couple of years is that our surveys are running all year round and the data is real time. So if you participate in a survey, then as long as your data gets cleared and vetted, then it goes into the platform right away. And that's great because we take down data that isn't current and we are refreshing with new information daily. In addition to that, with Wilson's help, with Wilson Sonsini's help, we have all kinds of questions on merger and acquisition, change of control and severance, outside board member compensation, size of option pool, salary increases. I mean, we really cover the holistic approach to compensation. And we cover across all sectors, but the jobs that we cover include chief, VPs, all the director roles down through staff level, clinical, regulatory, the finance, business development, so it's important to really understand the landscape here because many of the jobs now today are very much to be able to move between different industries, right? So it used to be that only one role would usually be engineering, and now you can be working for a robotics company or an artificial intelligence company. So there's a lot of transparency. We also you can participate in the J.Thelander survey for no charge and get access to a subset of the results, and also that will put you into our the newsletter, our whole private company digest, and we're really taking our data today and turning it into analysis, which is the great why LaunchBio is doing these webinars because. Listen, the data is only as good as you know what to do with it, and all the topics on, life science, male and female CEOs, how they're compensated. So we have a whole archive of information that you can also access, and this will help you. This is all for no charge. We really want to be a resource with the, and Scott will get into this sort of the pay transparency and what's required, because now more than ever, it's really great to be using data to understand what's going on in the market. So without further ado, I'm going to jump into some comp data. We cover biotech, device, clean tech, and tech industries. Again, many jobs like finance and business development, really segue between all these sectors. Best way to look at data, and Scott and Christine, of course, want your input on this, and also the fact that there is so much financing at later stages because companies aren't going public longer, but it used to be somebody's Series A was pretty consistent. And now you're seeing that somebody's Series A and somebody's Series B could be very different amounts of money. And we like to look at compensation data by the total amount of financing because it really allows you to look at the right mix between cash and equity. And also maybe, Christine, you could speak to what's been happening with valuations and how that is impacting, the stock prices, down rounds and so on, and why that's not really a great way to be looking at your compensation.
Yeah, I mean, I think what we're all seeing right now, and it's no kind of hidden secret, right, is that valuations are down. It's taking a lot longer to become public, and more importantly, everybody's fundraising is different. You're seeing Series A's at like $300 million valuation and $100 million raise. So it's really hard to be going and benchmarking yourself off of what is a moving target. And so it's really important to be looking at your total financing raised to date as the initial starting point for then where you benchmark your executives comp. And, what we are seeing, and we can dive into this a little bit later as we get into more of the detail, is just, and Scott can jump in too, because you're just seeing a lot of, in these down rounds, what are executives doing with, repricing options that may be underwater. And that's driving a lot of what you already own relative to what you may be trying to negotiate to get in addition to. So really important to look at the total financing raised to date. And this is why we love Jody's data, because really this is the key benchmarking piece that you have to look at as a starting point to decide where your executive team comp flows from. So Scott, I don't know if you have anything you want to.
Yes, Scott, jump in.
Yeah. I think that capital raised is a great way to parse this nowadays. Trying to do it by like Series A, Series B, it means so much different things between companies. So it's a little bit like comparing apples and oranges. And so I do think capital raise is a really good way to look at it. I also think that if I'm an executive and I'm looking at a company, I want to understand valuations. I also want to understand the cap table. And so what I see a lot of times is people get enamored with a number of shares, and kind of fixated on what they believe. Hey, look at me, I'm getting an option to acquire 250,000 shares. Well, if the company has a cap table with 1 billion shares in it, then 250,000 shares isn't all that much. So really making sure you understand the cap table, kind of what the dilution is and whatnot, and exactly what your ownership level is key, I think, in these sorts of situations.
Yeah, let's talk about that. So I'm going to move into actual data. The data that we cover is about 90% domestic, and within the United States, all over regions are, as from LaunchBio, and those of you that have labs, that there can be lab space in the Midwest or in California, Boston, New York, all over the place. And let's get into the comp levers. We did have a question come up about remote working, and we will talk about that, because the reality is that there has been, in the private company side, we've run many sort of these sort of hit it and quit it short surveys right away to see what's going on. And we consistently hear that there is no adjustment for people that are working remotely. And really, it depends on the adjustments that are being made or for jobs that are not key. Anybody who's crucial to a company, there has not been an adjustment. And somebody that is remote working, where that job is easily replaceable, then those jobs are on a case-by-case basis, but no hard and fast rule. So the different levers for compensation in private markets include base salary. What we look at, J.Thelander, is current bonus, which means it was actual bonus that was given. And target bonus is what's out on the horizon for the next year. And then total cash. And total cash can be a mix of base pay and bonus, or it can just be base pay. And then the different buckets of equity are founder shares, and then founder shares for the current role. So if you're this founder CEO and you got your founder shares, then you get additional equity, or could get additional equity as you are vested or diluted, or a combination of both, for being the CEO. But that's a different bucket than the outside CEO coming in who is not a founder. And Scott, we go through this all the time. Is there any hard and fast definition of what a founder is?
No, I mean, usually it's somebody who obviously started early on, and usually it's the people who actually founded the company, right? Who were there from the get-go. We do see that as somebody is brought in maybe after the company is formed, but at a very early stage, they want to be called the founder, because obviously there's some advantages to that. So I don't know that there's any hard and fast rule, but I think that there is you get to a certain point of evolution of the company where it's going to be hard to call someone founder. So it's got to be something that's very, a label that's given very early on.
Right. Okay, great. So I'm going to get into, because I know we've got a lot of life science companies, and I have biotech data, medical device data, tech data. So we'll do some comparing and contrasting. But this is for a biotech company that's raised under $15 million in total financing. And the sample size here, the N, is 101. And we're showing you base pay, median, 75th percentile, and maximum numbers, which has been, these max numbers were really used quite a bit in the last prior year and 2 years ago when the market was extremely hot. So we show you base pay, bonus is the actual bonus. So this is a bonus that was given, and then total cash. And you see exactly what we were just saying, right? The median base pay, or the 75th percentile base pay plus the bonus, does not equal the total cash, because there is different sample sizes. Not everybody has a bonus. Some people's total cash is coming just from their base pay. So I hope that makes sense to everybody, but feel free to throw in a question if we need to get into more detail on this. And then the founder total equity, which also could be a combination of founder shares plus additional equity for the founder in their current role, which is CEO. And then non-founder equity, which is for the CEO who was hired outside the company. Now, Scott, this goes exactly to what you were talking about. These are a percentage of fully diluted shares. So maybe we could just break down what that means. And then Christine, if you could jump in as to if this person and you are having a conversation, how does that conversation go? So Scott, you're up first. Tell us about the percentages and what you're looking at here. Uh-oh, Scott, you're back on mute.
God, I hit mute because my dog was barking, so I apologize. When we think about fully diluted, we are thinking about your potential dilution, right? So we look for what's actually outstanding. So there's typically preferred stock, right? And then there's also common stock. And then there's rights to acquire stock. So there can be warrants outstanding for investors to acquire additional preferred stock. There's also the employee dilution. Employees might have rights to acquire shares through options. There also might be a pool, an equity pool that's available. So you're looking at kind of what is the ultimate potential dilution, and then what is your potential ownership, and how are you taking that ownership? And so I'll let Christine jump in a little bit in terms of how you might take the ownership. But like for instance, if you get a stock option versus actually buying the stock, but we're thinking about your ownership or your potential ownership versus the potential dilution for the entire company.
Right, because you're going to get diluted down, right? I'm going to show the next slide. So Christine, you can talk about this in relationship. So this is a biotech company that's raised under $15 million in total financing. Now, this is for a biotech CEO that the company has raised 15 to 50. So you can see the founder total equity, the median and 75th have been diluted down, right? From the median at 21% and the 75th at 36%. Now that person's been diluted down to almost 8% and 14% respectively. So has the non-founder CEO, right? That 6.3 and 9 have gone down to really consistently 5%. This is exactly what you're talking about. So Christine, when you're sitting with this executive, what kind of topics should they be thinking about, and what questions do you ask them?
Well, first it's really just understanding what are the levers that you can pull when you're negotiating around this, and then it's where are you shaking out, right? So you've got the base pay, you've got the bonus, and then you've got the equity. And what are the components of the equity? Typically, the founder equity is going to be founder shares that you hopefully, no doubt, just exercised on the way in when you founded the company. So those. The clock has been started there for qualified small business tax, QSBS, and for long-term capital gains. The other piece, if you are a non-founder CEO and you're coming on, is, to Scott's point, can you buy into the equity? And what are you being granted? And it's not an or, it's an and really thinking about the types of awards. Typically, the smaller companies, you're going to have a mix of an incentive stock option and a non-qualified stock option. And
I pulled the slide up for you to see.
Thank you. And the restricted stock units and awards typically come later on in a company's life cycle. And those are a lot trickier, just given the way you account for them on the company's balance sheet, and then as they vest, the impact to the employee. But most typically, in the size that we were just looking at from a compensation standpoint, you're getting in ISOs and non-quals. And the most important piece there, and what we often find, is that founders are like, oh yeah, no, I own equity, or CEOs will say, I have equity, I own equity. And then when you really start digging in, it's equity that hasn't necessarily been exercised. They are options. And so remember, as the company gets later on in the life cycle and the spread gets bigger between the strike price of what you were granted it at and the value down the road, not only do you now have a cost of exercising them to start the clock and take full ownership of them from a tax standpoint, you also have a taxable spread on that gain. So really thinking about when you might want to consider exercising those to start the clock is critical. There is something, and I don't want to dive in too far too fast, but I will just touch on it here quickly, is just, the most important piece, again, and I always say this, is just understanding what you own and how you own it, and what your options, quote unquote options, are available to do with your ownership. And
right.
Oftentimes you can think about starting the clock early exercising. And that the IRS allows you to do that while filing an 83B. And you start the clock for tax purposes. And really what you're out is the strike and no spread. So there's no tax impact. There's just a cost to buy them. And again, It's not an all or nothing, because you can do more down the road. But what you're doing there is starting that clock for long-term capital gains, but also for qualified small business stock exemption, which at a very high level, and I can go into it more down the road, but at a very high level really is if you have less than 50 million of assets on your balance sheet, which again, if you've raised less than $50 million, you're typically pretty good there. And you're a C Corp, if you start that clock, you can hold it for 5 years. And after 5 years, the first 10 million is gain is exempt from federal taxes. And sometimes also the way you, what?
It can be a big deal. That's a lot of money.
Really big deal. It's a lot of money. It's a lot of money. And then you can also get creative. What we do with our clients is structure it as additional trusts around that as well, and move them out of taxable states like California. And then you get the full 10 million exempt from federal and state. So you could literally layer that. We have clients that have gotten $40–50 million exempt from federal taxes by structuring it the right way. But all of that depends on really understanding what you own, right, and taking advantage early on of some of these opportunities that exist.
Scott, your thoughts on this? Talk us through the ISOs versus non-qualified, restricted stock awards.
Yeah, most companies are, for people that start early on, try to get stock in the hands of the individuals for the reasons Christine's saying. From a tax perspective, you're much better off holding a capital asset, starting your holding periods, so you can get favorable federal income tax rates down the road. As the company progresses and the valuations increase, how to manage that and do that becomes a bit of a business decision and choice for the individual. Very often, as the valuations start to increase, we see people hold their equity in options, which obviously very valuable in terms of being able to benefit from the upside in the stock and not having to put capital at risk. The downside to that is that when you eventually exercise, obviously you're going to have ordinary income rates. So the choice here and the goal here is, if we can take something that might otherwise be ordinary income and turn it into capital gains, we can save you money in taxes later, right? And so that's really your choice: is do you try to figure out a way to take the risk and put the stock in your hands up front, and hopefully we can do that, especially when the valuations are lower. Or do you get to a point where you say, hey, that's just me putting too much capital at risk, and I just can't afford it or afford to take that risk, so I'm just going to hold it as an option. So the way I look at it is, if you're willing to put something up risk up front, you're buying a lower tax rate later. Right. Obviously, that's subject to the risk of, is this company going to succeed, and all those other things that go into it. So there is some business decisions to be made there. But from a company perspective, there's usually ambivalence as a general matter, other than wanting employees to feel good. So employee morale sort of issues. Ambivalent in terms of whether we grant options or restricted stock, because at the end of the day, having people become owners is a good thing. There can be some issues to address from a securities law perspective later on when we sell the company, but those are all manageable. So mostly what we're really trying to focus on for companies is how can we best manage the taxes for individuals later on.
Because on restricted stock, right, Scott, as you typically need a double vest, because the time-based vest causes a taxable event on private stock.
So as going on my screen, this is left to right. The ISOs are eligible for favorable tax treatment. The downside for an ISO, if you hold on to it, is there's kind of two. Is when you exercise, there's potentially an alternative minimum tax. So in addition to your exercise price, you have to manage the AMT. If you end up selling the shares right away, you're going to have an ordinary income event anyways. All right. So, and then going to the right, non-qualified options, when you exercise, that's ordinary income, the spread between the fair market value and your exercise price. All right. So that's the potential downside there. That the real gotcha on NSOs, or non-qualified options, is there is a tax withholding requirement when you exercise. And as a private company, if the company's private and there's no liquidity in the shares, you have to come out of pocket for that tax withholding. So that's usually the gotcha. Like, oh my goodness, I didn't realize I had to pay taxes and my exercise price. Now, when it comes to structuring the RSU awards, as Christine mentioned, is when an RSU vests and we deliver the shares, again, that's an income event. And so the value of those shares is ordinary income, it's wages subject to tax withholding. So most private companies don't want to have to deal with the tax withholding and don't want to have to put their employees through it. So to incentivize employees to help build the value of the company and get them to a liquidity event, we build in typically what we do is we build in a double vesting event. So it's two things need to be satisfied. One, you need to have your normal service-based vesting. And two, we add in a liquidity event requirement. And usually that liquidity event requirement has to occur by an outside date so that we can still have it respected as a vesting event. So I don't want to get too deep in the weeds on that one, but the idea is that we have a double sort of double vesting to delay the tax event until there's a liquidity event.
Yeah.
And then lastly, restricted stock awards is, I think Christine mentioned, early exercise, where the idea really behind that is buy the shares now, become an owner of the shares so that you can start your holding periods.
And the only thing that I would just add on that is if you actually do have a mix of ISOs and non-quals, when you exercise non-quals, to Scott's point, it triggers a lot of ordinary income. Incentive stock options, you actually only owe the tax on the spread when you're in AMT.
You say the spread, that it means between where the valuation price was and then
the strike price.
And
typically, if you are generating so much ordinary income, when you do the AMT calculation, you can fall out of AMT and not. So there is actually, and we've done this for a lot of clients, there's a little bit of a break even where you can, if you've generated a lot of ordinary income in that particular year, and you are pretty far out of AMT, you can actually exercise a certain number. There's a certain number in there that you exercise of ISOs where you're just out the strike and the exercise costs, and you don't pay the tax because you're still out of AMT. So it's a nice little benefit just to be aware of.
How much goes into this, right? It's not just about the percentages of what you own, but it's also this planning and having this expertise from Scott and Christine is extremely complicated and nuanced and very specific to your own situation, and also can really impact your outcome in terms of tax and your wealth creation. So I'm going to move us forward a little bit here into a couple of.
If I can just add one point, because I come across this all the time in my practice, and I'm curious how Christine feels about this. Is one of the issues that we come across all the times is individuals wanting to transfer stock options into a trust. And from our perspective, while that might be doable from a securities law perspective, from a tax perspective, when the trust eventually exercises that option, first of all, to put an option in a trust, it will no longer be an ISO. And when that NSO is eventually exercised by the trust, for us, that's still income to the individual, not to the trust. So from a planning perspective, it's always, I feel like a lot of times we have to explain that to individuals, because a lot of people focus on the estate planning and gift tax planning sort of thing, but they kind of forget about that ordinary income piece. So I'm just curious, Christine.
Yeah, we typically don't do a lot of planning with options. That's why we'll also look to exercise so that we've got seasoned shares that we can then use for gifting down the road. Transferring options into trusts are really very difficult. Also, you don't get the QSBS benefit, which is a lot of why you also want to transfer some of that upside. And anyway, there's a lot of reasons it makes it very complicated. So yeah, we're aligned there.
Yeah, so sorry, Jody. I know you wanted to move on. I just want to
move on so that everyone gets a flavor for what's going into the details here. So I'm going to go. I know we had some comp data and people want to see the data, but I'm going to sort of go backwards into this. So the type of awards we've really talked about, the vesting is always vesting, right? And it's typically time-based vesting, although there are now performance and time-based vesting. So you can grant equity as another incentive for a bonus, or if you want to, the investors sometimes also want performance shares. The vesting is typically 4 years. And there has been some discussion, and I know in a previous webinar, we had one of the partners from NEA on who said, yes, that she had seen some additional movement towards a 5-year vesting schedule, but 4 years is typical. And there's typically a 1-year cliff. This is where we're going to segue back to the comp data, right? Do you have an evergreen program to grant follow-on refresh options? And in most cases, or in almost all cases, 90% there's a refresh program, but it's not a formal program, or no, they don't have an evergreen program. And the reason for that is, we're going to go back to the data, is because it really depends on your starting point. There is no one way to do this. And of course, Scott, would love you to weigh in on this, but if you're looking here at this data, we'll go back to what we had seen before, this biotech data, for example. So if you have a CEO that was granted the 55%, they were at the max, right? And they're diluted down as they go from the 15 to 50, let's go into the 110 million plus, right? And they're diluted down, but they're still at that high level. Then they don't get a refresh grant because they don't need it. If that same CEO came in from outside, non-founder, and now they're down to 2 or 3%, then that's where they get a refresh because they're below the market data and where they should be. So what's your take on the refresh, Scott? And what's your definition of this for anti-dilution? I mean, there's dilution. It happens.
Yeah, no, absolutely. I think you bring up your explanation of it being kind of all over the place and ad hoc is absolutely consistent with my experience, right? So you have some different philosophies and different focuses by both boards and individuals involved. So I'll get some founders who just kind of put their head down and keep chugging along, and everybody's starting to realize while they're getting diluted, hopefully the value of that stock is going up. So notwithstanding the fact that for instance, in your previous slide where somebody had like 50% maximum, and now it's down to 15%. In terms of value, and what the value of that 15% is greater than what the value of the 50% was. So that's what your trade-off is. So everybody's expecting dilution as you go along. From a founder's perspective, in terms of whether or not you get refreshed, is it's a little bit of, are you going to ask for it? And then there's a lot of board members who are like, well, don't you have what you already need?
Right, it's got to come from somewhere, because we'll look at the option pool information, but this is the number one issue that founder CEOs have. And Christine, you touched on this as well. You're very altruistic. You think the board's going to take care of you. Now you're hiring in other executives, and you're finding out that where you are in relationship to everybody else is not right. You don't have enough. And you've got to go back to that cap table and really make sure that you're requiring that you have what's competitive.
I don't know if that's to me or Christine, but I agree. I agree with the statement. If I was a founder, I think it's at least fair for you as a person who's founding the company, has been diluted over time, to at least ask the question, should I now be further compensated with additional equity? Notwithstanding the fact that you're a large shareholder to begin with, you're the one providing the services and doing everything. So I think it's a fair discussion to have with the board, how to approach it. There's various ways to approach it. And Christine, I'm curious kind of how you've advised your clients on that.
I think, all of what you guys said, it's executive dependent. It really depends on the negotiating position that they're in, and what they can, ask for and offer. So, I would just kind of say, so we can, for purposes of moving on, I think that all makes sense in terms of what we're all saying. So I won't jump on the train.
Well, this is the option pool piece of it, right? So this goes to exactly right. If you're the executive or you're the CEO and you have given the right amount of equity, right? You're somewhere you decided your strategy is that you're going to be high on equity and lower on cash in the beginning, where you have more equity and the price is low, and then you move to a transition stage where the equity becomes more valuable and more of a commodity, and the cash is a little easier because you raise money, which is of course tricky right now, and it's taking longer. And you got to figure out. So this is an example of an early stage company of the ownership. So the founders, and the mix of the equity here for the founders depends on how many founders there are. The employee pool is right around that 10 to 15%. And the investors have, depending on how many investors you have, own, somewhere the 35 to 66%. Now you go to the next level of, here we go, the mid-stage company, and you've got $15 to $50 million of financing. So now the founders have been further diluted. The investors own more, and the employee pool is still hovering around that 15%. Now you get to a late stage company, and the founders have really been diluted down, and the investors are owning more, somewhere around 80%. And the employee pool now is even up a little bit, because you're probably hiring other key executive chiefs, depending on what you need for your next hires, and included in that employee pool. And this is, Scott, where I want your thoughts. And here's late stage. So the same thing, the employee pool is staying, but this is where, talk us through this slide on percent of fully diluted reserve capitalization, all reported data. So what does this mean, right? This is where tell us where the labels are.
Sure. If you want to maybe go to the, look, we can do this one. So you have a actual ownership by the employees, including the founders. Then you have this potential of dilution through your equity pool, right? And then, then you have all the other outstanding and board members I would kind of consider to be, typically part of the employees. because typically that board membership ownership is through independent board members.
Exactly.
And so your investor board members typically are not having their, granted equity granted to them because they're pretty much in there because of their investment already, right?
Right. That's
So,
how we see it too. That's how it's done here.
yeah. And so I think, you see this balance between how much the employees own versus how much the outside investors own. And there becomes I think, a healthy tension between the two, in the sense that, you got these investors saying, hey, look, we want you to be smart with how you're delivering the capital. It's a valuable asset. And employees are typically saying, hey, look, we need to be fairly compensated. You need to give us more. And so you kind of have this negotiation between the two. I will say that if I was a founder or a top level executive, this is something to be extremely aware of, understanding these percentages, understanding where you sit relative to that cap table. Because, if you hear a VC board member sneezing, it's not because it's allergy season. They're allergic to dilution. And they're going to push back on any potential dilution. And that can be through, granting employees and yourself individually additional equity. It can also be we haven't really gotten into this, but some of the vesting provisions in connection with, let's say, a change of control or termination of employment. So that's where I think really understanding the push and pull in terms of the entire cap table and the varying interest and, frankly, what your leverage is in terms of that negotiation.
Yeah. So let's talk about this. This is the accelerated vesting. So this is where you get into employment agreement areas, right? So you would have this is all predicated on the foundation of the fact that the company has gotten their equity grants and their cash compensation competitive to market. And what we're seeing is that the market's very stable. Companies are staying private longer. So as you raise more capital, the equity does get diluted down, those percentages get lower, and the cash typically gets higher, right? And so here are those change of control provisions, or if there is an event of a change of control. So this is the accelerated vesting, and it's not only for the CEO. We look at this for every executive, but typically, Scott, there is accelerated vesting in the event of change of control, right?
Yeah. There's what we call single trigger, which is you're just going to accelerate on a change of control, no matter what.
There we go.
There's also what we call a double trigger, which is you get terminated following or in connection with a change of control. And I'm going to have to work backwards here for a little bit because there's an influence. So in the public company realm, you've had your institutional investors really push back on single trigger vesting. And as a result, you see a lot of double trigger vesting. And the way that executives tend to protect themselves to effectively try to get themselves a sort of single trigger is through the negotiation of what would be viewed as good reason to leave, terminate, and still get the benefit of their acceleration. So that, but it's usually structured as a double trigger. Pulling back a little bit as a private company, we will see more single trigger sorts of events, especially for companies that really know and understand their exit is extremely unlikely to be an IPO and is most likely to be a change of control. And in those situations, we will see executives negotiate for single trigger or something along those lines. So, and frankly, in most life science sort of companies, we see buyers typically not want to what we call assume the awards and continue them. They usually typically want to cancel them at the change of control. So we kind of quote unquote cash them out. As a result, there's the transaction itself usually results in an acceleration event. So
right. And we go through this for every single job, CFO and so on.
Oh, yeah.
Christine, talk about a little bit with the loans. What happens here if somebody needs a loan, they want to buy their equity, because then there's going, they know exactly what Scott said. There is going to be an M&A transaction, and they want to have the full acceleration, but they also want to be able to buy their loans and they don't have cash. How often are you seeing that?
We were seeing that a lot more before the market change, when everything in biotech was up and to the right and companies were feeling really kind of great about the business and banks were willing to lend. But I would say that's probably less of a risk that I would say executives are even willing to take on at this point, but companies certainly are not flush with as much cash to be able to make those loans. So, I think it's more of just thinking about, again, those different levers that you can pull. I think to Scott's point, like if you've gotten farther enough along in the timeline and the life cycle of the company, and now you're thinking about potential acquisition or IPO strategies, it's really just making sure that your employment agreement, that your stock plans, that everything's gotten written in there so that you can solve for what you are planning for as hopefully the inevitable, whether it's an IPO or while you're public and acquisition. A lot of that is a lot harder to do the later you are. The other thing that I would just throw out there is, again, these are all negotiating points, right? So if you want to give on single or double trigger, but you really want, something else written into
your employment agreement, or you want an additional grant of some type of a performance-based equity, like
Right.
thinking about those ways, because equity isn't just straight equity, right? There's time-based and then there's performance-based. I also think that there's different types of equity as you're a founder and a founder CEO. And oftentimes founder CEOs will think about, their equity, or the board might just look at it as a straight equity amount and really splitting out what you received as founder. And if you've been there for a really long time and you've been acting as CEO, like what is that additional amount that may be time-based and performance-based, and a different type of equity that you're getting to add to kind of your pool of ownership in the company. And then I would also just say, like, what we've seen sometimes with founders is taking very little cash, but then the companies are taking so much longer to be private, and they've now found
Sooner or
themselves.
later, that's going to have to level off. I mean, I had this conversation with a founder CEO yesterday, a client on the consulting side, and she said, we're hiring a chief medical officer, but we can't afford to pay them to market, so we're going to give them more equity. And my recommendation was, and Scott, I'd really like to know your thoughts on this. Isn't that valuable? Isn't it important to document that so that at least you're saying, you're not paying to market, and that the equity is high, so that your house is built on a foundation that can't stand the test of time, but you're going to level that at some point.
Jody, I couldn't agree with you more in terms of trying to make sure that's part of the institutional knowledge of the company. I cannot tell you how many times companies do some sort of one-off arrangement, have a very specific idea in mind for an individual, and then everybody kind of forgets why that was done. And they just start looking at it like, well, blah, 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 got this in equity, and they kind of forget why they did it. So absolutely making sure that maintaining that institutional knowledge. If you do something that's one-off, make sure that everybody remembers and agrees that, hey, this was a very special situation.
Yeah, I mean, that total equity, the number that Christine's talking about, is extremely important. Make sure the founders have additional equity, plus their founder shares, if in fact their founder shares have been diluted and they're not staying competitive to market. Christine, I know we had a question.
There's a question around vesting and typical time for vesting. If the equity award is given for achievements at the end of the year, should it be given at a 4-year vesting schedule? You want to pull your data up, but that's typically what we see.
Yeah, so I'm going to move back. So here is, let's see, that's post termination, and the vesting period, 4 years. That's also for refresh grants. I mean, Scott, this comes up. We've asked this in our salary increase and bonus survey. If you give equity in lieu of cash, and then how is that awarded? Is it a dollar for dollar? And also, how is it vested? I mean, we don't really see much exception to a 4-year vesting, but you probably have a different, insight into that.
Yeah, no, I hate to say this, but it's going to be it depends. We see sometimes where equity is being granted sort of in lieu of an annual bonus.
Right.
And sometimes we'll see immediate vesting, kind of like, hey, look, we would have paid you a cash bonus, so here's an option, it's vested. Other times we see companies say, well, no, we are granting this equity as a performance related equity. Hey, you achieved A, B, and C, but it is going to have a standard 4-year vest. So I've seen both, and I think the way I kind of think through whether or not which one makes the most sense, I think you got to take a more holistic approach in terms of your compensation arrangements for everybody. You can't just look at this one specific thing and say, hey, you should do A or B. It's got to be what makes most sense in terms of the entire compensation arrangement.
Yeah, exactly. And I think that's the biggest piece of this, is that the whole component of this is, I'm going to move to this slide, might be helpful to answer this a little bit. is, do you typically require 1 year of service investing in any shares for new hires? And that's yes. And then we offer company loans for early exercise, 90% saying no, exactly what Christine was talking about. And then if you do offer a loan, obviously that goes, it depends on the level of the employee, would typically be the CEO. And then the early exercise and the time for expiration here is, if someone leaves a company, is typically 90 days where someone can and make the decision. The best, Christine, we talked about this yesterday. So how long does someone have before when they leave a company, to exercise their options?
Typically 90 days. I mean, that's the standard. There is a question around when annual bonuses are typically paid, and are there financial tax implications to consider for the company and the employee?
Yeah, so I'm going to move right in here. We're running our salary increase and bonus survey right now, which is great because we published this. So, and this is percent who received a salary increase for the coming year by industry. So you can see here that, you know, the CEO, and then, but by biotech, medical device, and tech. And I'm going to go slow because I know I tend to run through these and people want to see this. And you can see that the employee level tends to have salary increases, the manager level. At the top levels, it really depends on the climate of the business. Same thing for medical device and same thing for tech. And then this is, let's go by percent of received a salary increase for the coming year. We're running 2023 right now, but this is 2021 and 2022. And this is by job. And you can see that 2021, there was a very big year, right? There were a lot of people being paid at those 75th and max numbers. So my expectation is that for 2023, those people that were bumped up very high are not going to be receiving a salary increase coming for this next year, but we'll have that data. And we certainly encourage you to participate, because bonuses are typically paid in the beginning of each next year and in the first quarter, although it really depends case by case on a company's cycle. But we start running that survey now, and we close that survey right around just after Thanksgiving, hoping that people have made those decisions. But that's not the case for every company. And then here's the median salary increases as a percentage of salary by industry. It's so consistent, right? So not everyone's at 5%, really depends on your starting point. So if you were low to begin with, then you're going to be higher. But if you were high because you got a big bump in 2021, then you're going to be lower likely for this year. And you can see tech was a little more erratic. Scott, I see you smiling at this. Thoughts?
I'm fascinated by the data. I hadn't seen this slide, and I'm fascinated by how consistent it is across the board.
Yeah, it's very consistent. Actually, comp data in general is very consistent. It's the use of the percentiles. I think that's something that comes up all the time with clients. They want to know how fast moving the data is. And we have a very real handle on this, right? Because as we started and as we're winding up here, you know, our data is real time. And to move a percentile, an average and median numbers, really takes a lot of information. It's the use of the percentiles within a company as it relates to your key employees. And that's why no two company has the same key employee. And I'm going to go back, because I know there was also a question on this with geography, right? And again, that really, depends on, the value of this job, because there's not one exact way to look at data other than most consistently looking by the total amount of financing, right? So here are scientists by across the United States, right? So this shows you the blue is where the medians are the highest, and the greens are where the 75th percentiles are highest. And you can see in the Midwest, Southern California, percentiles are very high. The numbers are high. And this is because they're like in the Midwest, academic institutions, also there may be other public companies that are competing for these same jobs. Versus New York and the Northeast, not the same, but we break out Boston and New York separately, but we also do one combination of Boston and New York and the rest of the Northeast together. But this just gives you an example of it. And then you can see like a research assistant, some of these more junior jobs, the medians are very high in the Bay Area. Again, in places where obviously there's life science infrastructure, and that tends to be Boston, New York. I mean, that's where LaunchBio does all of their events. And then here's data scientists across all industries and financing. When we look at data, all kinds of different ways to be able to know how to advise companies. But Christine, maybe you can talk about the balance sheet of what happens for the bonuses and how that impacts a company. We don't really get into those questions. We get into more of the amounts.
The balance sheet for the company on the bonus side?
Well, it wasn't a question about what happens, what are the tax implications for bonuses?
Yeah, I mean, I think it's really just like the fiscal year, how you expense it, right? And if you're on a cap, it really just depends from the company standpoint. One of the things that we see, I have a number of biotech executives that have done this where they don't actually pay bonus. They do spot awards throughout the year. There isn't a typical annual bonus. It changes the dynamic around the culture a lot, in a good way, actually. Because, you know, we all see this at our own companies, right? The minute you start doing year-end planning, everybody's in your office, everybody needs a little more face time, everybody starts taking a little more credit for what's going on, and they know that bonuses are coming. And so I think you have to start early, but for those of you that are starting your companies early, I think it's really something to consider. Penumbra is a great example where Adam Elsesser has taken that company from inception all the way through to a very large market cap company, and he has started and has stayed true to allowing employees to buy in. We actually help them write their employee stock purchase plan, so there's equity available that way, and there's no bonus. It's all salary, and then spot along the way.
We heard this at another event that we did actually at the Wilson offices in San Francisco, that the VCs like spot awards versus built-in bonuses, hard to track. And there's a lot of confusion because bonuses start to become an entitlement. We had a question around, is the median salary increase a cost of living increase? And no, it's not. So salary increases are meant to be some kind of adjustment because hopefully someone is moving up in terms of their job leveling. It can be a cost of living increase, but it's not necessarily, it's not a guarantee, and it's not something that's assumed every year. And some jobs don't have that because where they fall on the pay ranges, they're already at the high level. So again, it really depends on your starting point. So all of these questions have to be asked and answered in context. I know we're sort of heading to the end of our time here, and you can see that this can go on and on because there's many ways to skin these cats. I think it sounds from what Scott and Christine's perception here and perspective on understanding from their areas of expertise is that you really have to delve into this very specifically. It relates to you, your team, where you are in your financing, where you see how much capital you have to raise, where you see the liquidity event, what that liquidity event might be. You know, a lot of companies are not thinking an IPO as they're going to be their target. And we're certainly appreciative of the chance to speak with you all today. So thank you. And thank you to LaunchBio. And we'll turn this back over to Becky and Ruben to wind up for everybody. But we're here. We will send out, this is was recorded, so that we'll send out a link to the vid recording, as well as to be able to participate in the survey or any of the surveys so that you can get a subset of the results back for no charge. There we go, Ruben. Thank you.
Wonderful. Hey, thank you so much. Really appreciate your time. I'm sure you'll all join us in thanking Jody, Christine, and Scott for an incredible, insightful discussion. And thank you to you all for joining us. With that, we'll end the meeting. I don't think that there's anything else to say on the matter, except thank you very much and have a good rest of your day.